Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the December FOMC and the recent interest rate hike by the Federal Reserve. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, as we anticipated, and as markets anticipated, with about an 80% probability going into this, the Federal Reserve has in fact raised interest rates by 50 basis points. Powell basically advertised as much at his most recent speech just a few weeks ago. So really no surprises on that front. A 50 basis point rate hike is more or less what was suggested. It's what the markets thought we were going to have. And at the end of the day, that's what we got, right? To go back to sort of listen to some of the things that Powell said today, I just want to read off a few quotes just so we kind of get in the same line of thinking that Powell is in and has been in for quite some time. Now, he started off the meeting by saying something that he normally says, and that is, we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Later on in the meeting, someone asked if they would likely redo their goals for inflation. So basically, if they would reconsider their target rate. There has been a lot of discussion over the last year that the Federal Reserve would eventually raise their target rate because inflation will remain sticky. I don't think that's likely going to happen, but now the question was given to the Fed directly today, and this was Powell's response. He said, changing our inflation goal is something we are not going to think about. And then he went on to say, we are not going to consider that under any circumstances. Now, could there be something in the future to change that? I don't know. But at this point, Powell was fairly clear that they are committed to getting inflation back down to their 2% objective and not changing it to 3% or 4% or anything like that. He also said something along the lines of, and this was when he was asked about the unemployment rate and the general expectation for the unemployment rate, I believe, according to the SCP, is now 4.6% by the end of next year, which would represent, I think like 1.6 million jobs being lost between now and then, something like that. And Powell was asked sort of about that, and one of the things he said was, I wish there were a completely painless way to restore price stability. There isn't, right? So this is Powell recognizing that there is going to be likely some pain felt, and that they wish there was a way to get inflation back down to this 2% target. But he's sort of admitting that the only way for us to get there is for the labor market to experience some pain and to ultimately loosen up. And if you're curious why he would say something like that, especially, it seems like inflation has come back down a little bit recently. If you go take a look at the inflation rate year over year, you could argue that it's on the right path, right? It certainly looks like it's on the right path. However, Powell was once again adamant that this is nowhere close to being what they need to see to confidently say that inflation is going back down to the 2% level. And I think he even said, one of the things that Powell said today was, I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. He also said something, and he reiterated this a couple times, but he said, he did say the historic record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. This, of course, is something he said many times. The reason he says that is because back over here, you could argue that there was some premature loosening of policy, and inflation ended up going straight back up. So while it looks like it could be heading down, there's nothing to say that it can't just go right back up. And I think Powell is wanting to avoid something like that. They would rather over tighten, and I think he said that a meeting or two ago, they would rather over tighten and then have the ability to cut rates than to not tighten enough, which would lead to sort of this spiraling inflation issue where wage inflation spirals out of control just because the labor market remains relatively tight. He said that the participants continue to see risks to inflation as weighted to the upside, and it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Now, one of the things I wanted to talk about here is the initial reaction, right? Because when the 50 basis point rate hike came out, this was the general expectation by markets. But most of the move, right, a lot of the move that occurred actually occurred before Powell started speaking, right? There was a significant drop in some of these risk assets before Powell started talking. And I think if you really dug through, why did the market see such a sharp pullback? Well, one, it's a market, right? And day traders are going to day trade. Dubious speculators are going to speculate. And in the short term, it could be just a buy the rumor, sell the news, right? You know, buy the rumor that 50 basis points is going to happen, and then when it actually happens, a sell the news type of thing. You know, I don't spend too much of my time speculating on this type of stuff because you can find a narrative to support anything. You know, you could use the same headline to say, you could use the same headline and then just sort of flip it, right? Like it could be that if the market had gone up, the headlines would have read something like, you know, markets rally on the Fed slowing down interest rate hikes. But if they go down, it'll just be, you know, markets rally because the Federal Reserve keeps raising interest rates, right? Or markets fall because the Federal Reserve keeps raising interest rates. So you can always come up with a narrative to support any type of price movement. That's not very difficult. But one thing I wanted to point out is the SCP, the Summary of Economic Projections. And arguably this had some effect on that initial move by risk assets. If you take a look at the dot plot, they reference this often in its speech. If you're not familiar with what this is the FOMC participants' assessment of appropriate monetary policy, midpoint of target range or target level for the federal funds rate. So for each year, you can see all of these different people who filled out this survey where they think the terminal rate will end up being. Okay, what they think an appropriate terminal rate would be, or at least maybe the terminal rate is not the right way to say it, but just where will it be, you know, by that year, right? Where will it be in that year? And you can see, of course, for 2022, it makes sense that they're all on the same line, right? 4.25% to 4.5%. That's where the target range is right now. If you go look, right, 4.25% to 4.5%. So that's why all of these dots are on the same line right now, is because they're all in agreement, right? That this is where it should be in 2022, because we are all saying that we're just going to have one more 50 basis point rate hike, and that's it for the year, right? That's it. It's going to be 4.25% to 4.5%, and that's why they're all in agreement. Where they start to disagree, of course, is what happens in 2023. And this has shifted upward from where it previously was. So that arguably is why we saw such a sharp sell-off in the short term, not because of the 50 basis point rate hike, because this was all but known going into the meeting. It was the shift upward in the terminal rate in 2023. Now sort of the target that they're talking about is 5.1%, right? But not long ago, it was less than 5%, but now it's over 5%. Again, I've said many times, I think the Fed funds terminal rate next year is likely between 5 to 5.5%, right? This is my base case, is between 5 to 5.5%. And according to this survey, all of these market participants would essentially agree with me, except for these two people here, right? Where they're saying, and arguably, if they're saying it's going to be between 4.75 to 5%, that's already getting up to the 5% level. So you can see that a lot of the people on the committee are thinking that the terminal rate will be higher than 5%, right? I mean, you have a lot of people saying 5.25% in that range, right? So this line here will be 5.25%. You can see there's some people right below it, some people right above it, and there's two people that are calling for it to be above 5.5% by the end of 2023. What I thought was interesting is there's one person. I suspect that whoever this dot is right here is probably the same as one of these dots right here. There's one that actually thinks that the Fed funds rate needs to stay above 5.5% through 2025 and only come back down over the longer run. Seems somewhat interesting, right? So there's at least one committee member who thinks it needs to stay above 5.5%. So this is something that I think, you know, markets are looking at, because they're saying, well, not long ago, a lot of people were thinking that it wouldn't even go above 5%. But now a lot of the people surveyed are calling for a terminal rate above 5% in 2023. So arguably, this is having a pretty adverse effect on the markets. If you go take a look at Bitcoin, it's been in this channel for a little while now. It made that move to the top of the channel, and we've had plenty of these flags, these bear flags for the entire year. But it made a move to the top of the channel. It's currently back down. The S&P 500 has obviously taken a pretty big hit as well. It's back below 4,000. It's been all over the place, admittedly. So it's hard to take it too much away from this until we have a little bit more time to see where it slowly evolves. But again, arguably the big hit that risk assets took is not because of the 50 basis point rate hike. This is known, unless you want to go with the buy the rumor, sell the news type strategy. It's probably the SEP, the Summary of Economic Projections, where the terminal rate is now expected by a lot of committee members to actually be above 5%. And if that's the case, then it means simply that they need to keep raising, and they will keep raising. They will keep raising in 2023. Powell even said, this is what he said: "We continue to anticipate that ongoing increases will be appropriate." Now, I can't tell you. It seems like every single month for the last 7 or 8 months, there's a lot of people that keep saying that this is going to be the last Fed rate hike, right? This will be the last one, even going back to August, or even going back to April and May and June. There's a ton of people that keep saying, right, this is the last rate hike, right? No, it'll be the one in September. That'll be the last one. Oh, wait, they keep raising beyond September. November will be the last one. And December, right? This has been something that's been ongoing throughout the entire year. And I don't really necessarily think you can blame people for having this opinion, because normally the Fed, they're not this hawkish, right? They're not this hawkish. They talk the talk. They don't always walk the walk. The difference between this rate hiking cycle and the ones that you've seen for the last 20 or 30 years is that we have high inflation this time, right? It's not like we have low inflation where, the first sign of weakness in the economy, they just cut the rates and say, hey, let's continue the party. They're not doing that right now, right? Because inflation is still so high. It's going in the right direction, but it still remains very elevated. And so, this mentality of calling the last rate hike for 2022, it's like trying to call the bottom for crypto, right? It just simply hasn't really worked out that well for people who've tried to do that so far in 2022. Because if you've given it enough time, eventually the market moved lower. And if you gave the Fed enough time, eventually they raised the federal funds rate even higher. Now, if you go look at projections, again, it's tough to make too many decisive conclusions from this right after the meeting, because some of this isn't even updated. It's still saying there's a 20% chance of a 75 basis point rate hike. Of course, this will be updated relatively soon to show what really are the expectations. Right now, February market participants are basically thinking it's either going to be 25 or 50 basis points. Okay, if you go out to March, highest probability right now, coming in at almost 51%, is to be about 5%. So I think the argument here is that by February or March, the Fed funds rate will probably reach around 5%, right? If I had to guess, I would say, 5% by March at the latest, right? But they could do another 50 basis point next month. And if you're curious, what is the likelihood of that? Again, I think we need to give this a little bit more time to adjust. Someone asked Powell specifically, right, directly, if they would actually consider going with lower interest rate hikes, like going down to 25 basis points. He said they haven't really talked about that yet. So as always, he's not going to give us a clear answer on all this stuff. And I think he just said, as always, right, it's just simply dependent on incoming data. And so I don't think we're going to have a whole lot of clarity, at least just yet, on whether the next interest rate hike will be 25 or 50 basis points. It'll probably depend on, as he said, some inflation data coming in between now and then, and unemployment data probably coming in between now and then. My general expectation, as of right now, and has basically been this way for a long time, is that the Fed funds rate will likely hit its terminal rate somewhere between 5 to 5.5%. And I think they'll get there sometime before the middle of next year, at which point they will likely pause and stop raising rates. I don't think they're going to immediately start cutting rates. And in 2023, again, if you look at the SEP, which it changes a lot. So if I were to show you one of these a year ago, it'll look completely different, right? And they would not have gotten the right expectations on what was going to happen. But for 2023, there's not really an expectation of a pivot. And this word pivot gets thrown around to mean a lot of different things. You know, it used to mean QE, right, and cutting rates. And then it meant stopping interest rate hikes. And then now it's like it means just slowing the pace of interest rate hikes, which it seems somewhat desperate. To me, at the very least, a pivot is where they stop raising rates. Arguably, it's where they start cutting rates is more likely what I would call the pivot. But at the very least, I think it has to be considered when they stop raising rates. They're still raising them, even if it's at a slower pace. Even though it's at a slower pace, they are in fact still raising rates. And in 2023, there's not really a general expectation of a pivot by the Federal Reserve to start cutting rates. In fact, 2024 looks like a more realistic timeline for that, right? And then kind of going down in 2025 sort of lines up, if you follow the channel, right, with Bitcoin, it sort of lines up with the next halving, right? Could be a good narrative, right? The Fed pivoted and you know, money is cheap again. We have a new halving, and you know, whatever that narrative is going to be, right? We have plenty of time to figure it out, but you can kind of see how things are lining up, right? So we still have, I think we still have a bit of a choppy market to go. And of course, risk assets in general have sold off. I mean, the S&P is back below 4,000. Bitcoin is currently coming in at 17.7 after once again getting rejected by the top of this you know, uptrend channel. If you want to call it a bear flag, you can call it a bear flag. But that's where we currently stand. So hopefully this update is worthwhile and has given you an idea of what happened during the meeting if you missed it. And of course, we will continue to follow this. Remember, the yields they can be somewhat attractive. If you're not sure about risk assets and you don't know where to put your money, there's always these treasury yields. And you know, one thing that I like to do is, and I don't talk about this that much on the public channel because I just think it's somewhat boring and no one's going to really care. But one thing that you could always do, not financial advice, of course, is you can always just put it in one of these shorter term treasury yields, right? I mean, if you put your money in there for a month or 3 months or 6 months, just say, you know what, I'll get the yield and then I'll see what the market looks like in a few months, right? Nothing wrong with that. I've been basically doing that for the entire year, right? That's why I say cash is king. But again, there's shorter term treasuries, there's longer term treasuries. The longer term treasuries, yeah, they're not really believing it, to be completely honest, right? They sense that the economy is feeling a little sick, and you can kind of see they've been pulling back significantly here, basically since October. So the longer term yields, the long end of the curve, still suggests that the economy is starting to get a little sick, and that the Federal Reserve will not be able to raise rates too much longer. And if they do, they probably won't be able to keep them there. Of course, that's what the bond market thinks. I mean, the bond market now says one thing, Powell says another. So far, right, I mean, Powell's done what he said he's going to do. And that's raise interest rates. And that's to say they're going to keep raising them. And they'll hold them at a highly restrictive level until the job is done, until they get down, until they're confident they're on a sustained path back to 2%, which is their target. So again, hopefully you guys enjoyed the content. Make sure you give the video a thumbs up. Subscribe to the channel if you're not subscribed. We also do have a Telegram channel if you want to discuss this stuff, in the description below. If you want to talk to 40,000 of your closest friends, make sure you join that. Thank you guys for tuning in. I'll see you next time. Bye.